Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for October 5th of 2025. We will start off the chart pack this week with a brief conversation on some economics and economic growth. Here we have a plot of the various estimates by month. You can see it's a relatively busy chart from that standpoint, but you can see, here we've got a lot of different estimates at various points in time. You look at the actual numbers. This is an actual number from second quarter of 2025. We talked about this a lot, that we had a big bounce back, 3.8% on an annualized basis, and this is a seasonally adjusted annual rate here. Current estimate, as it shows in the data, is about 3.9% for the third quarter of 2025. And as you know, we just concluded the third quarter. So we're going to get the first reading of this later on this month. But as you can see here, particularly as it relates to second quarter and now third quarter, these estimates for real GDP have been consistently wrong from the really even the beginning of the year. So again, you take these estimates with a grain of salt. This number is actually coming to us by way of the Atlanta GDP Now number, which has been very, very efficient. If there has been an estimate out there that's been really as close to the mark as you can get, it's been that Atlanta Fed GDP Now number. But you can see the basically the consensus of all the estimates coming out of the analytical community have just been too low. And here is the Atlanta Fed GDP Now forecast. You can see here outlining various contractions. The first quarter, obviously, we had negative economic growth. That we did have a bounce back. You can see the average in this red dotted line here. Clearly, it connotes that we had a very long period of expansion, then the pandemic, and then 2022. So we had one quarter. Again, that was not confirmed by a second quarter necessarily. But as we stand here today, we're looking at again something above our long-term average, somewhere 3.8%. And again, I have to admit that this particular forecast has been very, very good over the last couple of years. Here we have Bloomberg Financial Conditions Index, and as you can see, we've had some more difficult periods in this time series going back to 1990. But as it stands right now, we have positive financial conditions. That means we have relatively easy credit and access to credit. That not to say that that there aren't pockets of very tight credit, and if you're not if you don't have a good credit rating, or your business does not have good trade credit, that could be a problem. But by and large, financial conditions are favorable. Inflation expectations, again, with the Liberation Day in the rear view mirror here, those have gone up consistently. Now these are basically 5-year forward. So this is the expectation of 5-year inflation 5 years from now. So think of it as kind of 10 years, but it's an estimate 5 years forward, and that number is right now about 2.3%. Lots of impetus on the dollar right now. We know we're about 10% lower on the dollar this year to date, and again, there's a lot of evidence that suggests that a weaker dollar will actually contribute to an inflation. That means our imports will be more expensive from a currency adjusted basis. You can see here that we've got in this blue line here, we've got the consumer price index as it is outlined here. And then you can see the broad dollar index in a inverted. So this is basically taking that green chart and like flipping it over. And so you can see that there's a pretty good correlation here. it's certainly not 100%. There are times where, you get these deviations, and but it would tend to suggest that a weaker dollar is going to raise the overall level of inflation by a modest amount. On this slide, we have some additional data here. This is information from the various Federal Reserve districts and on prices paid. And so we've got Philadelphia, we've got New York, Kansas City, and Dallas. And these are all pushed forward 6 months. So these act as a leading indicator for future inflation, as is defined in the green line here. It's personal consumption expenditures, which is the Fed's preferred index for measurement of inflation. And you can see that number right now, as it stands here today, is kind of in that 2.75% range. However, if you push forward all of these Fed regional price paid surveys, I mean, it gets you something closer to 4. And as you can see, going back to 2010, that when you push forward this data or when you lead it by 6 months, it actually becomes a pretty decent predictor of future inflation. So, we talk about the conundrum that the Fed has on lowering interest rates. You certainly wouldn't be, inclined to lower them a lot if you saw this chart and you said, hey, this is has the potential to lead to more inflation out there. But this is the conundrum that the Fed is in because the labor market seems to be loosening up and weakening a little bit at the same time that you have these potential price pressures on the near-term horizon. On this chart, we have a plot of consumer confidence, the labor differential component of that, and you can see here on the right-hand scale, you can see that that has moved up at the same time that we get U3 unemployment. This is the unemployment rate that is announced in the financial press that you know about. So currently our unemployment rate's 4.3%. And really, the labor differential moving up is not necessarily a good thing. What it does is it tells you that there is, when it moves up, that means that labor is in a weaker state. And so you can see here with all these red shaded bars, these are periods of recession. And in really every case here, you have that labor differential that's moving markedly higher really as you're in the midst of that recession, and then you see that unemployment rate moves higher in tandem, really almost in response to. So really the takeaway here is that you've got unemployment that's moving higher. We've been watching that, right? And as we just mentioned on the last slide, that's the Fed's problem right now is that labor is weakening a little bit at the same time that you're seeing, the potential for higher prices. And with a dual mandate, you've got to be cognizant of both. And right now, the Fed has basically said, listen, we're focusing more on this labor issue right now than we are on prices. And so that's, I think, tempering the enthusiasm, as it should, on wanting to lower rates a lot. But again, this is, you can see going back in history, this data series goes back well before 1970, and it has pretty decent predictive power. A couple of other things of interest here. We've got percent change in travel prices relative to August 2019. Here we've got basically, you've got flights that are maybe a little bit lower, and then just about everything else, though, is higher. And you see here, food away from home, car rentals in particular, and then hotel prices all up double digits here since August of 2019. U.S. unemployment, we've been talking about. You can kind of see this trend line, even going back to, maybe even 2022. You can see that, like, if you put a line of best fit, then you're probably looking more like this, with labor kind of like trailing off here. And again, we had a kind of a negative print here back in the June time frame, but labor is definitely softening. Again, it shouldn't surprise anybody, nor should it alarm you. This is kind of a part of the economic cycle that we're just dealing with. And so again, just looking through the front windshield on these data points. On this chart, we have Chinese exports. Not too surprisingly, after Liberation Day, you see all of these negative bars in white. These are Chinese exports to the United States. At the same time that China seems to have ramped up its exports to the rest of its neighborhood, its Southeastern Asian nations here, and so China is offsetting some of this lower activity of the U.S. From elsewhere. Been watching gold as of late. Very interesting dynamics going on in gold. We see here, this is the ETF holdings. There's more product out there that's tracking gold. And so just the gold ETFs holdings in themselves in terms of tonnage. And this would be ETFs that actually hold the precious metal. And you can see how that has gone up considerably in a relatively short period of time. This chart, we have trade policy uncertainty that we reached a fever's pitch earlier this year. It's come down quite a bit. We're still elevated. So again, we're not saying that we're out of the woods by any stretch, because generally speaking, with very small bumps in the road from a policy standpoint, you generally don't get a lot of trade policy uncertainty. So even though we've come well off our peak, we're still very high in relative terms. And so caution people not to get too complacent on that topic just yet. Another interesting dynamic, we have very, very tight credit spreads. And so when we look at the corporate bond space, this is essentially the difference between what we're going to call investment grade bonds. This would be like yields around 5%. Again, you see that trailing down just a little bit here. You can see this looking back over time, going back to 1997. So, we were in a period of kind of a broad secular decline in rates till we got to 2022, and then that has obviously reversed, but again, trending back down. And at the same time, what we've seen, and this is a very interesting dynamic, is that you've seen high yield spreads, high yield yields, I should say, really tracking not much higher than that. When you say, investment grade's about 5%, high yield is actually like 6.5%. And that's a very tight spread. And you can see when you head into recessions, you typically have much wider spreads. But there's absolutely no indication from the high yield market that there's any perceived stress per se in the investment grade, or excuse me, in the credit markets, and really no presumption of a recession on the near term horizon. Corporate capital spending, again, nothing that would alarm you or maybe cause you to believe that we're heading into a recession. You see that those patterns, albeit noisy, are generally up or trending positive, with the exception of the New York Fed, which did have a downtick. But again, I'm not seeing signals of a broad-based expectation for economic weakness. On this chart, we have weekly bankruptcy filings. Again, not a lot of noise here, but not a lot of directional interpretation that comes out of this. This is the blue. It represents a 12-week moving average, which tends to smooth out the near-term data volatility. And again, line of best fit, really not much change here. On this chart, we have business formation, both before the pandemic. You can see a general uptrend here. After the pandemic, we talked a lot about, like in 2020, 2021, people were at home, and it gave them the opportunity to start home-based businesses. And a lot of these are very small businesses, like under 5 employees. But you can see the rate of business formation is actually continuing to trend up at an elevated level from where we were before the pandemic. Housing market, not a lot of housing data this week. We'll probably, next time we have home builder surveys and some of the Case-Shiller data, I'm sure we'll go into a little bit of a deeper update. But this particular chart caught my eye in the sense that, we're very close to a peak in the number of home sellers who have reduced their asking price. And so this is kind of a proxy for really the health of the residential market. And if you have a lot of sellers that are having to reduce their selling or their asking price on their homes for sale, that tends to lead a little bit of price erosion by several months. So we've been making additional investments in private equity and private capital. I want to spend a little bit more time in these charts of the weeks, kind of giving you a little bit of background on that particular market. We do talk a lot about economics and the public markets, but I think it's fair to also add some data in on the private markets as well. So this is a chart that is looking at global private equity assets under management, around $5.4 trillion according to Apollo Investment Management. And you can see the rate of gain has been almost at a geometric rate as we look over the last 5 years in particular. And so and this pertains to the amount of capital that's been raised that has yet to be deployed. And you can see that dry powder has gone up quite a bit. So these are funds that are looking for acquisitions. They're looking for investments to deploy new capital into. And so I think this has a good, basically, I'll call it a predictive power on future growth within the private equity space. So continuing our discussion of the private markets, we have a slide here that plots the number of publicly traded firms against the backdrop of U.S. Domestically private equity-backed companies. And so you can see this inflection point happened around 2016. Green line represents the number of publicly traded firms, and that number used to be a lot higher when we entered the century here. That number was around 7,000. If you go back 5 years prior to that, it was around 8,500. And maybe a little bit less than that. But basically, we've cut that number in half. So we're about 4,000 publicly traded firms in this country. Now, again, in 2016, we had a surge. And again, going back to the prior slide that I just showed you, the dramatic rise, and particularly after 2020, kind of this meteoric rise of the number of private firms. And we've seen a drop here lately, but that number is still considerably higher than the number of publicly traded firms. And I call this a supply of public equity here. And this is basically the supply of private equity here. And this drop, to me, kind of represents the fact that a lot of these deals that have happened over the last several years have been at such a relatively high magnitude that it hasn't really caused a continuing increase in the number of firms. But again, the relative size, means that a lot of private equity money has been deployed, but for much larger firms. But anyway, the long and short of this is that the supply of private equity is much, much higher than the public equity. Okay, switching our attention to private credit now, we've got a plot of different forms of outstanding debt here in the U.S. And I think it's safe to say that bank loans are not going anywhere anytime soon, even though we have talked about inroads that have been made from the private side of the ledger, and that is actually illustrated here. But again, the banking sector is still fairly robust. You've got bank loans in the green line. You can see that with some hiccups here related to pandemic. And some pretty strong catch-up, heading into 2022, that bank loans are still continuing to rise along with the size of the economy. So in relative terms, again, bank loans aren't going anywhere. You've got investment-grade credit. It's in this light blue line, tracking very similarly, moving higher. But then you have all of what I'll call the private sector that's getting involved. And so you have these various components. Again, if you go back even like call it 10 years, they were certainly around. I mean, whether it's private credit, which is in this kind of amber line here, and private credit, that market in January of 2015 was really at a very nascent stage. We had leveraged loans, and we also had obviously high yield bonds. And what we're seeing here, we'll see this very poignantly in the next slide, is that private credit here, as of in 2022, has eclipsed high yield bonds, and so it's taken considerable share within that market, again, relative to investment grade and the banking sector, again, it's just a small sliver and probably, you know, trying to keep pace in terms of market share now. But all of these sectors are going up, but we're seeing the most rate of growth in the private credit sector. So this slide was what I was alluding to in that prior data point, looking at private credit and how it is taking share away from the high yield bond market. You can see a global high yield here in the dark blue. You can see that that's essentially flatlined, and even from its more interim peak, 2022, has actually come down at the same time that you see private credit expanding. And again, going back to even 2015, you know, private credit was still around, but you can see the rate of growth has definitely been much more pronounced. And if we dig a little bit deeper, we see the various strategies that are encompassed by private credit, most of which is in what I'll call purely the non-bank banking sector, corporate lending. And then beyond that, we have some of the more esoteric uh, configurations of private credit, whether it's backing infrastructure or particular assets. And then you've got collateralized loan obligations, CLOs, in the middle market. And then obviously you have real estate backed private credit. But really the mainstay here, again, is this is trying to take share away from the banking sector, as we saw a few slides ago. You know, banks are not going anywhere, but the inroads made by a non-bank corporate lending have been actually pretty outstanding. Here we have private credit as a percentage of total credit markets. And again, 2003, very, very small market, relatively speaking. And that's gone from 1.7 to 7.0 here in, well, let's just call it roughly 20 years. We have a chart of risk versus return. I thought this is always good to look at when you are thinking about portfolio diversification. Here is the S&P 500, and the way to read this chart is you've got volatility down here. You have return on this axis here, and so S&P 500 has given you at least over the last 5 years a fair amount of return, but with that you're taking 20+% volatility, and there aren't too many things that are above that. Obviously Bitcoin you've got here, which is completely off this chart, and again, what you're trying to find is something that fits along this so-called efficient frontier that gives you the optimum amount of return for the amount of risk that you're having to accept. And so we talk about that blended or balanced growth portfolio, 60% equities, 40% bonds, as kind of being on that efficient frontier. Obviously, you're getting a lot less. Here's the difference in the amount of gain that you're getting, but you're also decreasing your risk as well. And so, if you go back down here and just do the bond index, arguably, if you're looking at the global aggregate index, you've actually had a negative return with, albeit lower risk than equities. But you're looking at very anemic returns here if you're just looking at the Bloomberg U.S. aggregate, which is kind of that mainstay bond index. You're basically not making really anything. And so the art is to find tools within this spectrum, again, that you want to drive up your return, but you want to minimize the amount of risk. So this is the area that you love to be in. Again, 60-40 gives you a lot of diversification. And I just use this chart as a tool to explain the power of diversification. This is what diversification helps you with. I'm not necessarily advocating strictly for a 60-40 portfolio, because we're using structured notes, which helps to provide a dampener to overall volatility. We're using other tools to kind of help manage risk. But again, when we get into meetings with our clients and we talk about diversification, we're thinking about these types of relationships all the time. That's all we have for the chart pack this week. I will be out of town next week, so no chart pack next week. We'll be back in a couple of weeks. Hope you have a wonderful week, and we'll talk to you again soon.